All right, welcome back, everyone. It is Sunday, and I'm in the hotel, and we are still not back in our house. We don't really know what's going on, so I'm not even sure if we're going to be able to check out tomorrow. But if you didn't get the update, our house was flooded, and pretty much the entire front of the house was destroyed. So we've been sort of hip-hopping between hotels, and we finally found a stable hotel we've been at for a few days, and we got all our equipment and some clothes, and we were finally able to get some stuff, so we're getting back on track. I also found out that the government basically put out a news report today saying that ground turkey has salmonella. It was about 5 days too late. So I also had salmonella last week. That was not a good night. But we're getting back on track. All of the tests, I believe, have been graded. I think I have like 3 or 4 emails that have trickled in while I've been doing this. So, but if you haven't heard from me about a paper that you sent in or an exam that you sent in, check all your grades. Everything should be updated. And if there's something missing, please reach out to me. I had so many emails that I had to get through, and I may have accidentally missed something. I did not do it on purpose, all right? So please reach out to me and let me know, and I'll ameliorate that immediately. Okay, so let's get back on track. I will get back on track. Everything's sort of caught up. And I'll get a bunch of stuff posted in the next couple of days, okay? So thank you so much for being patient. Thanks for all the kind words. It's been a rough week and just a weird semester with the crazy storm and then the flooding and then so okay. Chapter 16, macroeconomics. We're going to be talking about exchange rates and international capital flows today. One of my very favorite professors from graduate school, Dr. Glenn Biglaser, who is now at the University of North Texas. This was his specific focus, and we wrote a couple papers together about foreign direct investment. So I really like this stuff, and I like understanding foreign investment especially, and how it works and why it works, and how we can use foreign investment ethically to help change the world. Okay, so I guess that's my dream. Anyway, all right. So let's jump in. Section 16.1: How the foreign market exchange works. Now, remember, we've been talking about supply and demand curves, and this works basically exactly the same. We still have the same underlying principles, okay? A currency is just a product that you can buy or trade. It's just weird in that we're just buying or trading a currency with another currency, right? And so there are some strange effects that we'll talk about because there is an instantaneous shift in the system when my demand for the US dollar increases, instantaneously the supply or the incentive to sell the US dollar from the other side increases. And so the supply never really changes, only the price, only the relative price. And so it's an interesting market. This is not one of my currency exchange is not one of my expertises. I love foreign direct investment. It's a very sort of specific piece of exchange rates and international trade, okay? All right, so here we go. You have 4 different groups who can participate in basically international trade or currency exchanges, however you want to think about this. You can think about it as supply and demand. We're buying a product for a price. You could think about it as trade-offs in separate markets. You could think of dollars as a simple product. There are some really interesting parallels sort of between inflation and relative prices. Okay, so there's a lot of cool stuff here. There's a lot of stuff here, so we'll try to get through. At least we're going to hit the basics, right? This is a tough chapter, and there are whole courses on this subject. So we're going to hit the basics as hard as we can, and then if you're interested, I can send you research on some deeper stuff, you know. And I'd actually like to put together a course in the future on international capital flows, because I really liked it. I really like studying it. Okay, so 4 different types of participants. We have firms who are involved in trade. And what happens is I have to pay my workers and some suppliers and wages and things of this sort in one currency. But then, and I also maybe collect that currency from the domestic market. But I also need input products or rare earth materials or whatever it may be from other economies, right? Because there's comparative advantage. We live in a globalized society. And so some countries are better at producing some things, or some countries even simply just have deposits of materials that have been randomly distributed by geological forces. And so it's just random. I mean, it's not random, right? We can prove why scientifically, but it's random in that lithium, right, only really ended up in sort of China and Bolivia and Afghanistan. These sorts of ideas that you can only find plutonium at certain points on Earth. And so that means that domestic producers have to be able to use currency to foreign currency to purchase foreign goods. We need lithium. The only place we can get it is from Afghanistan, and therefore I'm going to have to shift my U.S. dollars into Afghanis, which is the Afghanistan, the Afghani, right, is their currency, and so I need to shift my U.S. dollars into Afghanis to be able to pay their employees. Because that's how their sort of isolated economy works, right? It is based on a different currency. And so there are many, many different reasons why a company might need to be able to use multiple different foreign exchanges and currencies across the planet, especially when you're talking about big productive facilities or giant firms like Apple, which needs, hundreds of different components. And so it's pretty interesting, and it's interesting the types of leverage that the supplier state and the firm can have against each other. Like I said, there's a lot here to study, but the first is firms need different kind of currencies so that they can pay domestically and so that they can buy abroad. Let's see. I wanted to touch on hedge contracting. Imagine that I am a car company and I want to be able to buy, I don't expect a major advance in my lithium batteries for 5 years, so I want to be able to buy 5 years worth of future supply of lithium from, Afghanistan, okay? The problem is exchange rates can change drastically over 5 years, right? Especially in a third world sort of state like Afghanistan, where there's very little stability, there's barely a central bank, there's barely an economy, if we really want to talk about the truths of Afghanistan. That place is a mess, right? But I need lithium. And so I can literally hedge my bets, which is sort of where this term comes from, and say, okay, Afghanistan and Apple, not Apple, what would this be? Ford. Afghanistan, Ford, you're going to send your representatives, and then we're going to have a third-party interlocutor, whatever word you want to use here, insert in the center, right? And this is going to be either sort of a high-powered bank or a brokerage, some sort of financial institution. And they will say, okay, for a fee, we will determine a scheme for guaranteeing that Afghanistan gets paid everything for their lithium at this rate based on a particular exchange rate, right? And so to reduce the likelihood that this lithium is going to cost me a lot more in 5 years if Afghanistan's currency starts to get stronger, then I can hedge my bet basically and use a hedge contract through a brokerage for a fee to say that, okay, we're guaranteeing you that we will take your dollar between this range and this range, say $1.10 and $1.20 based on these conditions per pound of lithium. Or I don't know how it works, but just for hypothetical's sake. And we will take that same $1.10 to $1.20 for a pound of lithium for all of those 5 years at this fixed exchange rate. And if it gets wild, it'll shift us toward that $1.20, and if it's poor, it'll shift us toward that $1.10. But we were going to stay in this very small range, and we will pay a fee to be able to do so, to guarantee that we get that price at today's fixed exchange rate, right? Or some range of fixed exchange rates. So that's a hedge contract. All right. The second group of possible participants in currency markets are tourists. It's not a very big group. Third is international investors. And these are we distinguish, right? Foreign direct investment involves ownership. So by the rules of data collection, basically, that the World Bank and the IMF and American economists and German economists, etc., we've all agreed that 10% ownership or more is what counts as foreign direct investment, right? And there have been studies to argue why this is a good number and what the different incentives for long-term future growth and future stability as an investor. You're not likely to pull your money out if you have a certain blah blah blah. 10% is the limit, okay? If it's not 10% ownership, or if it's just stocks or bonds or currency reserves or any of that sort of stuff, they are called portfolio investments, okay? So there is a distinction in foreign investments between foreign direct investment, which includes ownership of 10% or more, and portfolio investment, which is non-ownership type investment or financial mechanisms or these sorts of things, bonds, stocks, etc. All right. You need to know that distinction. It's a very important distinction, not only in economics, but political science and politics and lots of different things. Okay. All right. Moving on. I would say read through figure 16.2 to sort of show you how exchanges in the currency market can either benefit you or hurt you as a firm. And then if you move on down here to the most traded currencies, I sort of wanted to show you guys this. There's a lot of talk that the Chinese yuan is going to become the dollar of the future, and everyone's going to start pegging their money to the yuan. Everyone's going to be buying up Chinese money, and the whole world's going to be run on Chinese money. It's not real. There's nothing to suggest it's real. If you look at, remember, all of this adds up to 200% because there's always two partners in a trade. And so you'll get 200% over the entire addition, all right? And so almost every foreign capital interaction, 87% of them all, 88% in fact, are in the US dollar. Okay, so, and then it's the euro, and then it's the yen, and then it's the British pound, and then it's the Australian dollar, and then the Canadian dollar, and then the Swiss franc, and then the Chinese yuan, or the renminbi, as they call it. So, it's overblown. Don't take it seriously. It's silly, and it's politicized, and I don't know. It's pretty goofy. Okay, if you also look at this pie chart, it shows you the breakdowns of pairs, because pairing is really interesting in the market, right? And so the plurality, right? The largest slice of the pie at 28% is trades between the euro and the dollar, and then it is the dollar and the Japanese yen, and then the British pound and the dollar, and then the Australian dollar and the dollar, and then the Canadian dollar and the dollar. You see where I'm going with this. Where is China? All right, 2.5% of, 5% of all transactions are between the American dollar and the Chinese. So, I mean, there's just nothing there to suggest that it's even to be listened to. All right. Moving on, I thought this was a really cute little graph, figure 16.4, and the intricacies of what really happens as the dollar appreciates or depreciates relative to another currency, right? It's not just all good news or bad news, as nothing in the world is. There are shades of gray and there are intricacies and nuances, right? And so, if you have, I'll walk you through this little graph, okay? If I am an exporting firm, I want to sell my stuff to China, right? And we're just going to use a U.S.-Chinese comparison just to stick to one example, all right? I am a U.S. firm, and I want to sell my products in China, okay? Suddenly, the dollar starts to become stronger compared to the Chinese. I can sell fewer of my products, right? If the dollar becomes weaker compared to the Chinese renminbi, then I'm happy because I'm suddenly selling more because the Chinese money is worth more of my product. Okay, so it's a good thing for me as an exporting firm. All right. Now, a foreign firm who wants to sell, a Chinese firm who wants to sell products in America loves a strong US dollar. And this is why China manipulates their currency. They know that if they manipulate and peg their dollar lower, their yuan, their renminbi, if they artificially reduce the value of their currency relative to the United States dollar, okay, that means that we will be buying more Chinese products and that Chinese will buy fewer of ours. It's just the supply and demand, right? As the currencies strengthen and weaken. And so China and other countries have been accused, and the evidence suggests that they're manipulating their currency in order to bring in order to sell their products abroad and increase their own domestic market, right? So there's a lot of benefits to that. You have fewer foreign reserves. You're selling more of your stuff abroad, which means they're bringing money back home to pay workers and buy supplies and build up businesses. And also, your citizens are going to be buying your products, which also helps to develop your economy, and you're sending few of your currency abroad, right? And so this is why you get currency manipulation. All right. U.S. tourists abroad, they would be very happy if the U.S. dollar is stronger, right? Because now I can buy more knickknacks and tchotchkes or whatever you want to call them. And I'd be sad if my dollar is weaker because I'm not going to get as many, Chinese renminbi when I go to China to visit. I'm going to only be able to buy 2 Great Wall models instead of 3. Something. All right. Foreign tourists in the U.S., if the dollar is strong, they're not liking it, right? Because it costs more for them to buy our tchotchkes and knickknacks, and vice versa. U.S. investors abroad, U.S. investors who are abroad. Okay, yeah, someone who's sending foreign direct investment into the United States. They are not happy with the strong U.S. dollar. They want to see a weaker U.S. dollar. And then vice versa for an investor who wants to send money abroad. All right. 16.2. This is what I was talking about with the weirdness in the markets, right? And so figure 16.5 just shows you that, like, if you compare the dollar to the peso, you just flip it on the other side. It is just a mirror image of each other, okay? 16.6 is a lot more complicated, and I sort of want to spend some time to just walk you through the argument piece by piece to make sure that you really understand it. I try to do this on the more complicated graphics, okay? So, but I find that sort of breaking it out step by step really helps students latch on, okay? And I would also suggest I am a huge proponent of the Socratic Method. It is proven through neuropathology and other neurosciences and through evolutionary biology and through other things that actually speaking out loud, even if you're alone, though it's not as strong, but speaking out loud and even just reading through these things out loud or talking to someone and debating them helps you make the long-term synaptic connections that are necessary for real learning, and not just shallow rote memorization learning, right? And so it's very, very important that, and in class we would be doing this all the time. I try all the time to just throw out questions and let you guys talk to each other. But it's vital that for the more difficult concepts, you take some time, and I would even literally say, I know you're going to feel goofy, but sit down and talk to yourself or read it out loud. It is proven scientifically to help you learn, okay? So it's very important, especially for concepts you're having difficulty with. It helps you learn the nuances far better. All right, moving on. Okay, so we're going to walk through 16.6, okay? Excuse me. All right, so first, I want you to assume that we are at equilibrium zero, right in the center of all the mess, okay? And I'm only going to walk you through the shift from equilibrium 0 to equilibrium 1. I will let you do the reverse to equilibrium 2 because it's just simply the same pattern in reverse, all right, like many of these have been before. But I want to walk you through one direction, okay? All right. So we are assuming that the United States and Mexico are purchasing each other's currencies for reserves. There are companies and firms that have to have pesos. The U.S. government is probably buying some supplies, etc., right? There's always these transactions. So we're talking about the transactions between the United States and Mexico. At this moment, we are at equilibrium 0, where it costs $1.20 to buy a peso, and there are 2 billion supplied to the market. Okay. Then we're going to move to 2. 2 says that the Wall Street Journal publishes an article that says that the value of the peso is going to increase. Maybe there's some new policy in place. Maybe the state discovered new oil reserves. Maybe, I don't know what it is. Maybe there's a responsible politician in office. I don't know what it is, but the Wall Street Journal decides that maybe Mexican pesos are going to be a good investment in the very, very near future, like right now. And so right now, everyone rushes out and tries to get pesos, and demand increases from D0, the line D0, it shifts up to D1, right? And under the normal circumstances of economic modeling and supply and demand, there is a lag between shifts in demand and shifts in supply. That's not how foreign currency markets work. They are instantaneous transactions. And supplies and demand are instantaneous and computerized. And so, when under normal circumstances we would shift out to D1 and then compare that to S0, now not only are we shifting from D0 to D1, but we're also shifting S0 to S1. Because at the same time that demand for Mexican pesos is increased, the supply of Mexican pesos by those who want to make the new money, who are holding pesos right now, are putting them on the market so that they can take advantage of this new price, right? And so what happens is the market, the supply of pesos stays exactly the same. And the central bank has to do nothing. There is no change whatsoever, but the relative exchange rate changes, and now the peso, the equilibrium has shifted from E0 to E1, and the peso is worth $1.40 now instead of $1.20. But we still have a stable supply of 2 billion pesos in the market. All right? Okay, that's a lot. I know. I also wanted you, through point number 7, I wanted you to look down at figure 16.7. You can see the same exact tendencies and rules being applied when we're talking about interest rates. And then point 8, we're talking about the exact same thing with differential interest rates. So that'll move us through that section. Okay, so it should be pretty simple if you just stop it step by step and sort of walk through the argument. All right. Okay. I guess we should touch on arbitrage. They mentioned in the book, this can be a pretty lucrative business for people who live sort of on a national border, especially where 2 different currencies are used. So, this wouldn't be useful in Germany and France, who border, but they use the same currency. So it's not like I can take advantage of it. But, if I live in Egypt and I'm bordering Tunisia, I can take advantage of differential currency rates, right? So if a bicycle costs me, say $100 in Egyptian dollars, but that same 100 or that same bicycle cost me 80 in Tunisian, I can take that $20 differential by just buying a bunch of bicycles over the border, walking them over to Egypt, and selling them in my shop, right? And so this usually, it does exist. It's almost inevitable, right? Especially in very short distances over very short times. There's a pretty good industry in this, honestly, but it'll balance out eventually because of supply and demand, right? And because of the need to keep currencies up to date, which is what the PPP exchange rate is for. The purchasing power parity exchange rate, it's a mouthful. Purchasing power parity exchange rate, right? This is just the idea that, I don't know if you remember, I hope you remember. We talked about the CPI, the Consumer Price Index, and the basket of goods, and we're trying to tag prices all the time and figure out how inflation works. It's the exact same thing. We're taking a basket of goods across international borders and across different currencies, and we're trying to figure out exactly what your dollar is worth for 6 apples versus what your Japanese yuan is worth for 6 apples. And then, the peso and the dollar and the yen for bicycles and blah, blah, blah. Here's a giant list. It'll help us figure out, how these currencies are changing compared with each other, okay? But let's see. Okay, we're just going to skip down to 16.4, exchange rate policies, and I will leave 16.3 to you, because we've talked about almost all of those things before. So, 16.4, exchange rate policies. These are some of the actual policies that governments can implement, and not even really governments, central banks, and I guess insofar as they're independent, if the central bank is not independent, then it's probably the government or the leader or the military, general or whomever is leading the country. Okay, so there are basically 4 different types of policies, and it's really like on a scale. It's not 4 types because they blend and merge, but there's 4 theoretical types, I guess I would say, and actually only 3 with 2 subtypes of pegs. Okay, so the first is the floating. Almost everyone knows what this is. This is 40 to 50% of the world's currencies are floating, and they are simply based on the invisible hand. What are market forces saying about the value of one currency relative to another? Okay, and this is the dollar, this is Japanese yen. These are most of the major currencies on Earth, and then the pegging starts to happen with the less major countries, the weaker economies, the ones who are trying to reduce the vast swings that can happen when your economy gets a lot smaller, and money being pulled out or put in can cause really big swings rather than, it's kind of hard to do that in the American or the Chinese market or even the German or whatever. But when you're talking about Zimbabwe or Argentina or Peru or Guatemala, all of these states are really small and they have small economies, and so small additions, relative to a tiny addition in the United States might be a huge investment in Guatemala, or vice versa. If I'm pulling it out of Guatemala, it might be devastating, So a lot of the floating exchange is for the powerful, the really powerful economies and currencies on Earth, right? There are soft pegs, and this means that we're not saying that it's going to be 20 pesos to a dollar all the time, constantly. We are going to do everything we can. We're going to shift our money supply. We're going to pull money in and buy reserves and all of these things to keep it pegged to 20 pesos per dollar. That's a hard peg. A soft peg is we want it to be around $20 per peso so that we can plan economically, but so that we can get the advantages of the free hand of the market. We're not really going to step in unless things start to get really out of control, right? If we start to see some major indicators that our currency value is dropping or even increasing too much, we're going to step in and make adjustments, macroeconomic currency adjustments and reserve adjustments that'll help to stabilize that sort of thing so that it doesn't go too far one way or another, all right? There's a lot of reasons to do this. Why would you want to peg? Again, like I was talking about, the smaller economies can get into real trouble. We have seen numerous times. In 1997, we saw sort of the Asian market collapse. In 2002 and 2003, we saw the Argentinian market collapse. And what happened is just fear sort of entered the system, or maybe the exchange rates busted, and now the banks owe a lot of money that suddenly they don't have because their currency that they're exchanging in isn't worth as much as the dollars that they borrowed in now, because suddenly our currency depreciated. We lost half the value of everything that we owe back. We're screwed. And so that's what happened in South Korea. What happened in Argentina was capital flight. And I shouldn't say South Korea, excuse me, in Southeast Asia is what I meant to say. This is Thailand, Indonesia, Malaysia, Vietnam to a certain extent, this area, With Argentina, what happened is they had a lot of investment. Like investors were really high on Argentina. They were like, okay, man, Argentina's kicking butt. Their infrastructure is good. Their medical system is good. They have a really good property rights system. So investors are kind of high on Argentina, It's a beautiful place. They have a really highly educated population. I mean, it's a cool country, and you would think that good things were going to happen. But suddenly you got the Kirchners, who were basically communists, like hardline communists, come into the state, and it caused a lot of fear, and massive amounts of investments just disappeared overnight. And their economy just collapsed because they lost like 30% of all their investment overnight. I mean, literally overnight, and it just spiraled, right? And so you get that spiraling situation where, okay, our currency is collapsing, now demand is collapsing, now employment is collapsing, our entire economy is collapsing, and we're in a recession, and if we're not careful, it's going to keep sinking. And if you add on top of that, Argentina owes billions of dollars in loans to the World Bank that now they don't have. It is a nasty, and it is still a problem in Argentina 19 years later. So these things can have some devastating consequences. And actually, Argentina and some other countries are trying to implement capital controls, is what they call them. The idea that you can't pull out your investments, you can't pull out a certain percentage, you have to leave it in the system a certain amount of time. But how do you monitor that? How do you police? Like, what is a firm just buying products and input for its own production facilities versus portfolio investment? Or it's really hard to police. So this, while capital controls are a great theoretical idea, and they have helped insofar as we can enforce them, they're not perfect. They're not perfect, and we still get this just vast capital flight. All right. Okay. What are some of the trade-offs of the pegs? I wanted to at least present you with three. You get the hard peg. This is when a state wants to ensure that its currency is pegged to another so it can stay very stable and it can do other macroeconomic planning. Unfortunately, that means you're constantly changing your foreign currency reserves to keep the differential exchange rate pegged the same. You can't just say it's pegged. You have to actually buy and sell currency to do that, right? And so that means you're in a dangerous spot. That means you can't use those self-same tools to sort of buy your way out of a recession by pumping money into the system and creating aggregate demand. You can't really fight inflation, and we know that inflation is a problem for these smaller countries. It's not really a problem in developed world anymore, but it is a serious problem in developing countries. So this can be a really difficult thing, and a central bank can put themselves in a real tight spot because now they've lost all of these tools to be able to fight in their own domestic economy because they're trying so hard to keep the world economy's fluctuations from affecting them. Issue 2, the opportunity cost of holding foreign reserves. This is a problem too, right? If I'm Mexico and I'm suddenly having to buy American currency to keep our exchange rate stable, the more American dollars that I am holding in reserve means that's money I can't spend in my own market. I can't use it for research and development. I cannot use it for aggregate demand pumps. I can't just make government jobs because I can't pay people in dollars because no one takes dollars. This is Mexico. They take pesos, So, some places probably take dollars when you're close to the border, but when you get down to like Guatemala area, they probably don't see dollars all that often. So that can be a real problem because that's just money that's sitting around. You can't invest it. You can't, hand it out for social welfare. You can't do any of these things. And instead it's actually losing value because of the natural 1.5% to 2.5% inflation that developed economies have just naturally. So it's a tough situation again. Number 3 is the problem of the soft peg, and this is the rumor mill, and it's kind of a fun problem, right? Because it doesn't really have anything to do with the strength of the economy. It's about mass psychology, and it happens because you have a soft peg, right? Okay, I'm the central bank. I say, all right, guys, we want to be able to control our economy. We don't want the vicissitudes of the economy swinging too wildly. We don't want exchange rates to get too out of control, so we're going to put out a soft peg, right? And we're going to try to keep the exchange rates between $1.10 $1.10 and $1.30 for the peso. And if it starts to go too far in either direction, we're going to stop. All right. But then investors and bank managers and hedge funds and blah, 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 all of these different people, they start talking about when are they going to set, when are they going to set the limit? What sort of cap are they going to put on there, or at what moment are they going to do it? And they're constantly hypothesizing that something's going to happen. And so this false information spreads in the economic community, and it oftentimes, research has shown, causes more swings in these soft peg economies than if they had been floating to begin with. So it's really wild, and states are starting to move away from it toward just saying we're a hard peg state and letting it just sort of drift a little more than a hard peg state would do, but not declaring we're a soft peg state because of the problem of the rumor mill. It's really cool stuff. Okay. All right. That is it. So, that is not it. There's one more. The merged currency is the final type, right? We have the floating, you've got the soft and the hard peg, and then you have merged currencies. So this is like the EU. Some countries even use the dollar. Zimbabwe, I think, uses the dollar, formerly Rhodesia. It's supposed to help reduce the stress of having to exchange currencies all the time, and the competition that entails, and the difficulties that businesses have to deal with. And so it reduces some of the inefficiencies in the market, right? Theoretically, and I really do think in reality, part of the problem, though, is like what we're seeing with the EU, right? Germany has been relatively staid and responsible about their economy. Greece, on the other hand, has been spending like the world's going to end. And so Germany is having to deal with the irresponsibility of Greece. And so, in a sense, the responsible countries in the EU are propping up the irresponsible ones, and the irresponsible ones sometimes take advantage of that. That sucks, right? And arguably American states do the same thing. If you look at the South actually takes way more from the federal government than they put in to the coffers. And so the South is a big old welfare queen, in the terminology of Reagan. And so it's sort of the same concept that you have in the EU, where Greece is sort of screwing everybody over. Well, so is Mississippi and Alabama. They take way more than they give back. So, and then they yell at California and New York. California and New York are actually adding to the pot. Because they tax their people and they offer resources. So it's pretty funny, like the political stuff. Okay, that's it for the day. I hope you're all doing well, and I'll get more up soon.